Hello, everyone. This is A.V. Powell. We're going to start this webinar shortly. I'm monitoring the attendees as they track. We have about 44 signed in thus far. We may have more registrants than what we had space for because we were tracking the numbers quite closely, and in the last 5 minutes we've exceeded our account number. So I'm going to have my assistant, Lynn, see if she can sign in and change that. We may have to restart the webinar, but don't worry about that. I'm still tracking the numbers of folks coming in, and so we'll start in about 2 or 3 minutes, so hopefully 1:05. And if any of the panelists are on, just, Lynn, are you on right now? I think you can talk. The attendees aren't allowed to speak just yet, but I still want to give a little bit more time. Okay. I tried to find the place. I'm looking. I see about 44 attendees so far, 45. The numbers are trickling in, but we'll start in at 1:05. Are you getting a bit of feedback on my connection right now? Anyone that can? Brad, are you on as a panelist, or Jack?
Yeah, I'm here. I'm not getting any feedback.
Good. Okay, I just want to make sure that the sound is clear.
Yeah, looks good to me.
Okay. I'm going to take the webcam off for a minute so that I can freshen up, but I'll be right back.
All right, sounds good.
Looks like we're at about, let's see, 51. I know that when I last checked, there were over 100 registered, so I want to get at least to 75 or so before we start. They're kind of trickling in, but we'll give them a few more minutes.
Okay.
Actually, maybe 1:06, but I think we have sufficient time for folks. While we're waiting, there's some housekeeping. I believe that you, while you're muted at the very end, we will have a panel question and answer period, and you can type in questions, and I'll be able to see those and respond to those. If you notice my eyes going back and forth because I'm trying to look at the control panel at the same time, but I'll try to minimize that during my presentation efforts and all. But okay. So you will be able to, for the audience, you will be able to actually send in questions, and we'll try to answer as many of those as possible. And let's see, we're up to 54, and this is being recorded, so even for those folks who can attend, they will be able to get the recording and all. So there should be a way to handle all this. They can only get to at least 75 or so, maybe it's 60. For sure, we're at 56 now on this. But we'll start. I'll give it about a 90-second countdown, and then we'll get started. And I do appreciate everyone's patience in attending and participating in this and planning. When my webcam comes back on, that means that we're getting ready to start, and it'll be another 65 seconds. Okay, we're up to 58, so once we get to 60, we'll go ahead and get started. 2 more. Okay. 59. And they count. The ball is dropping. 10, 9, 8, 7, 6, 5, 4. All right, we're ready to go. Good afternoon, everyone. Thank you for participating in this webinar designed for residents and prospects of CCRCs. My name is Alan Powell, and I'll be conducting this presentation today. We'll be presenting for about 55 minutes or so, and then we've allowed about 30 minutes for question and answers with our panel. At the present time, only the panelists and myself can speak, but you can ask questions via the chat line, and we will monitor that at the end and try to answer as many of your questions as we can, time permitting. During the presentation, we will like to just go through it first and then open it up for questions. This presentation is being recorded, and it will be made available to those who are of interest afterwards. Also, there is a handout, I believe, that's available on the webinar site that you can get it, as well as we'll be happy to send that to you. if you are not able to locate it. Well, we'll go ahead and get started. And let me begin by what sort of takeaways should you expect from listening to a webinar on what do resident stakeholders need to know about actuarial reports? Are they a tool for confirming financial strength? Well, the first takeaway is, what are actuarial studies? What are the different types and what do they mean and which ones should we use? But I think the most important takeaway is, I hope that you'll come away thinking, learning how you can measure the solvency of your CCRC, and in particular, your entry fee-based CCRC. Regardless of whether it's type A, B, or C, if it has an entry fee, this actuarial analysis applies to it. Let me begin by going over the agenda. First, let me just say, actuarial science is simply a tool that is populated with assumptions to develop a business plan for a CCRC. And with that business plan, one can forecast what future pricing will lead to and the financial strength of the community. In regard to our topics today, I want to define the different types of actuarial reports, because that's the source of confusion when people say, well, I've had an actuarial study, but it may not be the focus of the solvency study, which we call comprehensive actuarial studies, or ASOP number 3 actuarial studies. And I'll explain ASOP in a minute. Then I want to go over what is the content, what you expect to see in an ASOP number 3 actuarial study, followed by how do you interpret the information from actuarial studies. And then lastly, using the real estate axiom of property, location, 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 what are the critical factors for stakeholders, assumptions, assumptions, assumptions. As I mentioned, actuarial studies are simply a tool that, if populated with reasonable and credible assumptions, will give you a good sense of what will happen for a CCRC in the future and determine whether or not its fees and reserves are solvent and adequate. Well, this slide right here, I could have left out, but I wanted to give all the attendees a chance to impress their fellow residents and prospects by being able to speak the actuarial talk, and you'll know all these acronyms and really impress people at your happy hours. They're fairly straightforward. Actuarial, ACR is Actuarial Compilation Report, which is a term we use for our clients who actually get annual actuarial studies. And you may say, annual? Well, I'll explain why they do it annually in a bit. ASC is actually the accounting terminology, and for a while, there's a big interest in how entry fees were recognized as income, and it was going to be changed and was changed by ASC 606. And ASC stands for Actuarial Standards Codification. The big item here is ASOP number 3, or Actuarial Standards of Practice. Back in the early 1980s, my professional organization, the American Academy of Actuaries, developed a standard of practice for all actuaries doing actuarial studies for CCRCs that define their content and format. And this is the kind of study that you're looking for to determine whether or not your facility is solvent and will it be in the future, or whether it's projected to be so in the future. CAS is the same thing as ASOP number 3, Comprehensive Actuarial Study, and it's just those terms are interchangeable. ASOP number 3 study or Comprehensive Actuarial Study. Present value is a concept that has been around before actuaries, and it's the discounting with interest. A new concept, and one we'll spend some time on, is the FSO, which stands for the GAAP Obligation to Provide Future Services. I will explain actually how that is done in its use later slide, and GAAP stands for Generally Accepted Accounting Principles. Then lastly, the one item that you want to look for in your actuarial report is whether or not the opinion states, is your CCRC in satisfactory actuarial balance, and if so, under what conditions or assumptions is it in that satisfactory actuarial balance, and if not, what should be done to bring it to that level. Well, let's talk about ASOP number 3 actuarial studies or comprehensive actuarial studies. Typically, they're done every 3 to 5 years, either because of state regulations or possibly a bond covenant requiring it, or investors who purchase those bonds. The actuarial compilation is a term we use internally, refers to those CCRCs who do it annually, and I'll explain later why they do it annually. Some states that have statutory requirements for actuarial studies every 3 to 5 years are Arizona, California, Maryland, New Hampshire, New York, Texas. We do know that Pennsylvania and North Carolina required one time at startup, And in some of these states, not all types of entry fee contracts are covered. In some states, they omit or allow type C contracts, which refer to fee for service, to be excluded from this requirement. It's my opinion that's not necessarily appropriate, but that's just the way the regulations are. But those are the kinds of comprehensive or ASOP number 3 actuarial studies that you should be interested in to learn about the solvency of your community. Now, actuaries do other kinds of actuarial studies for CCRCs. The primary one is estimating the GAAP future service obligation. And we're going to talk about that in detail and why it's a major concern in a minute. It's an element of the GAAP balance sheet on the liability side, and it's a specific calculation defined by the accounting standards. Sometimes actuaries are called upon to do what we call actuarially based population flows, or residents moving and transitioning in functional status within the facility. They may start out independent, but then move to assisted living or memory care, and then to nursing care. And these kind of projections are often used to fill in for assumptions for feasibility studies for bond financing. Sometimes communities want to offer new contracts, and they say, well, we have an existing contract. Can we price the new one, which may have a different entry fee and monthly fee in different terms, so that it generates the same actuarial margin as our existing contract? That's a limited scope study, and it's just focused on pricing new contracts. Then lastly, actuaries may be called upon to develop life expectancies for your community based on your actual experience. This is used in preparing GAAP financial statements, and in particular the element that refers to income recognition from entry fees. So an actuary may be called upon to do this limited scope study. The reality is all of these tasks are included in the comprehensive actuarial study. So when you have a comprehensive actuarial study, you're getting all these, whereas there are cases where a community only needs a subset of the comprehensive study to meet their particular needs. I've mentioned at least twice before my concern about the future service obligation that's used in GAAP. It is a GAAP convention. It has the right name, and it's an element of liability on the balance sheet. To be a bit technical, that calculation uses an actuarial survivorship curve, or one of our limited scope study elements. But it's somewhat misleading in what it says. It's called the obligation for future services, but it really is more of a liquidation liability. It really doesn't truly measure the ongoing obligation to provide future services. One thing in that calculation, the actuary or the organizations allowed 10 to 15% of their operating budget based on the premise that period costs can be excluded. This simply means that marketing costs and certain administrative costs are excluded in the calculation. So it starts off by not really measuring the full going concern liability. It doesn't include future depreciation. It uses, in other words, future capital expenditures are not included in the calculation for the FSO. It combines present value with non-present value items, which is a problem technically. In regard to refunds, those are not discounted for the time value of money. And lastly, the income recognized from entry fees or deferred revenue liabilities doesn't necessarily match expenses. Now, when you do this calculation, if the number is negative, it's recorded on the balance sheet as the $0 or not recorded at all, so there's no obligation and doesn't impact your net assets. If it's positive, it will reduce your net assets. My point here is that this calculation, while it has the right name, does not measure your solvency, even though it includes an actuarial calculation as part of its convention. And my concern here is that the analogy I would draw, and it's true throughout in terms of using traditional accounting tools to measure the solvency of a CCRC. Traditional accounting tools, in my understanding, were based on measuring income for a given period that matched expenses for a given period. The challenge of CCRC is that entry fees prepay future revenues and expenses, and to my knowledge, GAAP statements have not been adjusted to properly reflect that. The analogy I would draw is that hiring a mechanic who was last trained on a carburetor to fix your fuel injection car. very unlikely he's going to be able to fix your engine. And the challenge here is that the gap-based tools, the ratio analysis, etc., just don't work for entry fee CCRC, in my opinion. And although we've been trying to converge gap statements and actuarial analysis that's embedded in the entry fee contract for years, it hasn't happened over the last 40 years. So my point on this slide is that if someone says that we have a negative or no FSO and that we're fine, that's just not measuring solvency. It's really closely analogous to the net asset value, but to be truthful, the comprehensive actuarial study was designed to actually meet those needs to answer your questions about solvency. And in particular, what are the solvency criteria? Well, they're fairly straightforward in my opinion. There are three. One, have the accumulated reserves that result from prepaying these entry fees, since monthly fees are typically less than the cost of care as the resident moves through the continuum in a CCRC. Are your accumulated reserves sufficient to meet those obligations of future residents on an ongoing basis? Similar to what the FSO does, but instead of being a liquidation liability, it's an ongoing liability. So that's criteria number one, and that's expressed as a funded status. Then secondly, is the combination of entry fees plus monthly fees for a contract sufficient to cover the expected cost of a new entrant over their lifetime? So sort of said, do we have reserves adequate for current residents when we bring in new entrants? Are they priced appropriately? That's a great start. And then lastly, the third criteria, because we're using present values in the prior two numbers, will the projected cash flows using the same assumptions be positive and sufficient to meet any bond or statutory covenant? These are the three ASOP number 3 criteria, and if a community meets those, then they're said to be in satisfactory actuarial balance, which, in my opinion, is the highest standard that a CCRC should meet. It means that this community is solvent as of that date. Now, I added that because this is something because once you do one actuarial study, doesn't mean you can put it on the shelf and never have to do one again, because things change. Assumptions and experience change. So while you may be in satisfactory actuarial balance today, 5 years from now, that may be different. So it's important to continually monitor and update your actuarial analysis. How is this expressed? Well, this is a sample from one of our clients that does their studies on an annual basis. We call it an Actuarial Dashboard. And we show the prior 2 years and also what the median is from our experience of other CCRCs. The funded status, which is the first criteria, and in this case we're using the actuarial book values, shows that they're over 110% funded in the prior 2 periods, and there's a slight decrease. The second criteria, the new entrant pricing, is done for there are 3 different contracts, and then a weighted average is calculated, and all of them have over a 10% margin. And you can compare that to the median margin of 11.8%. And in the funded status, our median funded status is around 105%. So this community is in a good position, although there may be a slight decline. And actually, we went in that report, there would be an explanation as to why the numbers went down and so forth. And the third criteria, the 10-year increase, projected increase in cash balances goes up, almost doubles. So this community is in satisfactory actuarial balance, which is actually shown down there at the bottom, the next to last item. We have another measure that we use for our clients, where we use the actuarial appraisal value for fixed assets that really combines the funded status for current residents with new entrants. And that number, when there's a surplus in new entrants, the appraisal value is higher than the book value. And so they show that they're 121% funded, and the medians are 103% funded. So this community is in a solvent position as of the last 2 years. We also look at, because we do actuarially based population flows, whether or not they have adequate healthcare capacity, and in both years they are projected to have adequate capacity. Now, you may see a seal over to this gold seal on the right. For those CCRCs that we do annually that exceed or in the top 40% of our experience, and that percentage varies, they're given the actuarial AVP actuarial seal. And it's just simply a way of acknowledging they are the better performers of our clients. But any client that is, or any, not only our clients, but any actuarial study that says a community is in satisfactory actuarial balance, subject to the assumptions, has met that minimum criteria or the higher standard for solvency. So the main thing is not whether or not to have a seal, but the fact if your report, when you read it or see it or is summarized, says this community is in satisfactory actuarial balance, that is the key. Now, I mentioned something about actuarial opinions and the context that they are used. The key here, as I read it, is that this community is in satisfactory actuarial balance. Is this the three words in the second sentence here is not really key whether or not they have the AVP seal. But what's important is that there are certain caveats that might be listed. Typically, monthly fees are assumed to match operating expenses. In some cases, a community may need to raise monthly fees 0.5% more or 1% more for a period of time to match operating expenses. If that's the case, the community can still be in satisfactory actuarial balance, but it's a little bit more challenged than one where fees can match revenues with expenses. Another key assumption that you want to look at, if you have that, and if you can see the opinion, is the relationship between the interest earnings, discount rate, and your revenue and expense inflation. Again, that number should not be too big. If it's more than 3%, that's sort of a red flag that maybe they're using pretty aggressive assumptions, and 1 or 2 is the norm. Another item is your average occupancy in independent living, but in all levels of care as well. The key is you'd want a community to be at least 90% occupied unless it's in a startup mode. But if you're achieving a satisfactory actuarial balance position where you have to increase occupancy by more than 10%, again, that's just an area of concern. Doesn't mean it can't be done, but you want to watch that carefully because oftentimes increasing those occupancy levels may not be met. Then lastly, one thing you want to make sure when you read the actuarial opinion or get is that they're saying that all of the accumulated cash balances, or at least the ones that are necessary to meet the funded status, are for the exclusive benefit of contract holders, and that's reflected. A couple things that might be added could be that there's a test to ensure that residents can pay the projected fees, and they are assuming they can do so, or there are funds available for benevolence to help those residents who can't pay such a fee. And then also a caveat might be listed that all of the actuary feels that all of the assumptions used in the report are reasonable. My point here is that what do you want to know about your actuarial study? Does it have an opinion that it is in satisfactory actuarial balance? And what are the key caveats? Are the assumptions reasonable? Are you assuming monthly fees pretty much match increases in expenses, the real rate of return, or the difference between your inflation and your investment earnings, and the occupancy levels? Those are really the 4 main items. One might look at capital expenditures, but again, the context is that the board and management are charged with choosing and selecting reasonable assumptions and working with their actuary. So it's their job really to set those assumptions. In an actuarial report, it might list out all of the assumptions. You may disagree with them, but at the end of the day, it's up to the board and management to choose a set of assumptions they feel are achievable and reasonable. Well, what happens if a community is not in satisfactory actuarial balance? Well, a couple of things. First, I want to say, just because you're not in satisfactory actuarial balance doesn't mean that you're headed for bankruptcy. And I'll share this anecdote from a client I worked with in the early 1990s. There were a new community being built in Virginia. When we did their first actuarial study before breaking ground, I believe there was some 88 or 90% funded. We talked about that with the board and options for raising fees more, increasing fees to make them 100% funded and start up. And they decided we're okay with being 90% funded at the beginning because the cash flows are showing that we will still meet our debt covenants. However, we will make adjustments along the way so that by the end of 10 years, we will be fully funded. And they're in a state that did not force them to be fully funded immediately, as in some states that are regulated, and that's exactly what they did. So 10 years later, on a gradual mode, they were able to get to be fully funded. And personally, I think that's the way it should be. Yes, when a community is not fully funded, there are some challenges and issues and so forth, but generally through careful planning, especially in a startup mode, they'll be able to get there as they get to their stabilized occupancy. But yes, there is some risk to residents, but the key is that the board had brought into funding their reserves and adjusting fees along the way to achieve their target, and the actuarial tool allowed them to measure their progress each year and get there and make sure they were making progress instead of moving backwards. Now, in general, if you're in a regulated state, that means that you don't meet the regulations. So often you'll be required to adjust fees to get to a fully funded status sooner rather than later. It doesn't necessarily mean you're going to run out of money. In fact, you could run indefinitely in an inflationary balance and be underfunded. Your solvency is dependent on intergenerational subsidies, which means that future generations will pay for the cost of current generations, which may be okay, but it's really up to the board and management if they feel that's fine. And there's a legacy passed on to future boards, which may be a problem in the sense that what if the entry fee contract you offer today is not sellable in the future, and you have to go maybe to an equity mode or a rental mode? Then you've got this liability that it could be argued prior boards and management should have dealt with, now is faced with this current board because they chose to be underfunded. And that really goes to whether or not the board is meeting their fiduciary responsibility. And then lastly, by not having appropriate reserves and surplus, you may not be able to handle any unforeseen financial crisis. My point is that even if you're not in satisfactory actuarial balance today, if you've decided to achieve that goal, you can plan for it and achieve it in the future. Well, next comes the question, well, how often should we do these actuarial studies? And in particular, I'm talking about the comprehensive actuarial study. In bond covenants, they're typically every 2 to 3 years, although in 1990s and early 2000s, some letter credit bond covenants required them to be done every year. From a statutory or state regulatory basis, typically the requirements every 3 to 5 years, and sometimes they're required once in an initial feasibility study for some states. For about 10% of the industry, they actually use the actuarial studies, the comprehensive actuarial study in a shortened form, a summary form, as part of their annual budgeting process every year. They do it with the preliminary budget, determine how much they should adjust fees, and in some cases, they may be slightly more than inflation, may be less, depending on the community's experience, and they use it to determine the appropriate fee adjustment to make sure they achieve their desired level of surplus and pricing accuracy for their clients. And this is done by roughly 10% of the industry. In my opinion, this is the only tool whereby CCRCs can accurately measure their solvency for a certain set of assumptions so that they have complete information to make their decision about pricing on an annual basis. So really, it's something that should be done on an annual basis. And you may ask, what is the cost? Well, I'm not going to get into cost numbers, but I'll give you a relative number. For those CCRCs that do it annually, we calculated that it's less than 1/10 of 1% of their operating budget each year. Let me repeat that. For those who decide to incorporate actuarial studies as part of their planning and use that information to determine whether or not fees are sound and what the appropriate adjustments are, the cost works out to be less than 1/10 of 1% annually. Now, a question has come up with many of our clients, and has been asked as often, is that in all of our reports, we typically include a statement, this report is written for those who engage us, typically the board and management, and may not be distributed to others without our permission. There are two reasons primarily we do that. One is if it's distributed to others, it's good for us to know in case they call us with questions. And so, well, we don't answer those questions right away because we have to check with our client for confidentiality purposes to answer those questions. But it's good for us to know that someone has the report. But then secondly, we really don't think that it's good, and this is something that is in another actuarial standards of practice, that actuarial documents can be taken out of context and may be used in a way to influence others. So generally speaking, we like for our reports to be distributed in their entirety. And I think that's pretty much the statement for all actuaries. Most of the comprehensive studies that are done every 3 to 5 years have a full set of assumptions. They're typically over 100 pages long. They're enjoyed by folks who like numbers, etc. But the key thing is the context of the opinion. Were monthly fees assumed to increase at the same rate as operating inflation? Is the facility assumed to increase actually in IOU by 10% or more over the next 3 years? It's those kind of things that's important when someone sees, is this community in satisfactory actuarial balance, but what about those key level assumptions? And so my point is that there's good reasons for it. not to be distributed, but again, it may be distributed in certain cases, but we want people to have the appropriate context. And many times we work with management groups to provide a one-page summary of their actuarial results, and it may even include the dashboard to share with their residents as a possibility. Again, there are a lot of assumptions involved, and so rather than get a debate on what assumption is the best one, that's really board and management's responsibility with their actuary. There are a possibility of summarizing the results if one is not able to receive the entire actuarial study that may be filed in a statutory report. There's no one answer to it. It really depends on the board and management, but it's not a question of hiding stuff. It's just that it's a complex report that needs to be used in an appropriate manner. Well, as we've come to an end of this session, what should a resident ask? Well, if I were a resident, and I may very well become one soon since I turned 65 last year, does the board of management believe that contractual liability should be fully funded, particularly if they're offering a contract with an entry fee? If the answer is no to that, that means they want to do pay-as-you-go funding, which is similar to what is done for our Social Security system. That would not be the kind of CCRC financial structure I would want to move into. If they say yes, then that is a good sign. Second question is the CCRC in satisfactory actuarial balance? And if the answer is yes, what are the key assumptions? The main thing to be concerned with are, to get there, do you have to increase fees more than internal inflation, or is it pretty much matching? Is the oxygen soon to be constant? Are there appropriate capital expenditures, et cetera? But 4 or 5 high-level assumptions is sufficient. But if not, what are the plans to achieve status? As I mentioned earlier, whether or not a community is in satisfactory actuarial balance right now, it's a snapshot. It's whether or not they plan to get there in the future and are working toward that. And there's no specific time frame it needs to be done in. It can be done as quickly as the next year, or it can be spread as long as 10 or 15 years. It just depends on the situation. As I mentioned, to go number one, what are the key assumptions to achieve SAB? Future occupancy, fee increases in relation to expenses, real rate of return, in other words, inflation in relation to your earnings, and expansion plans. So if you get a response back from management or see a report or summary that says this community is in satisfactory actuarial balance and the community and actuary believe the assumptions are reasonable, and you have those last items in number 3 addressed, then this community is operating at a high level and a reasonable level of financial security from you. They may have more surplus or less surplus as compared to others, but the point is they are in satisfactory actuarial balance, and that is sufficient. And if you don't really want to go through a 100-page report and study all the numbers, that's all you need to look for, and it should be in the executive summary. So what are our takeaways, or what I suggest is our takeaway? One is transparency and sharing the actuarial status is a positive trait of a responsible and a progressive board. That's not to say the boards that don't do that aren't doing so, but again, that's a good sign. If available, and again, I said if available because there may be reasons where they're not sharing the whole report, complete report, ask for the actuarial report, but otherwise, ask that they share what was the actuarial opinion in the latest actuarial study. Sometimes these are available with the state where the CCRCs are regulated. Compare with benchmarks, and I'll share a couple with you later in the appendix to this handout. Review trends in successive studies. You want the trends to be constant or increasing slightly. Know that the GAAP audit statement, FSO, or obligation to provide future services, has no correlation whatsoever with solvency. Let me repeat that. If a board or management team says, well, we have a negative FSO, so we're okay, that is a red flag because that does not correlate to solvency, which is your concern. Lastly, and most importantly, if the board has taken a posture that we want to be in the business of liability management, that cash is king is not sufficient, we want to make sure that we've managed our liabilities and are setting a course where fees and reserves will be accumulated to match those, that's more important than the current actuarial status. As I mentioned, you don't have to be fully funded today as long as you're making plans to get there in the future. And if you got a board that recognizes that an entry fee-based CCRC is an insurance type of product that requires actuarial tools to measure their solvency, that's a very positive sign, in my opinion. Lastly, Actuarial studies are not a panacea for success or solvency of CCRC. If a facility has a downturn in occupancy and it's a long-term chronic position, no number of actuarial studies is not going to solve that for you. It's a good indicator as a going concern for a facility with the appropriate assumptions, whether or not the pricing and reserves are sound, but it is not going to prevent bankruptcies if there are bad assumptions or if the facility is not able to fill up for whatever reason. So my point here, as I said in the beginning, this is a very useful tool to know where your community is, and to look for it being in satisfactory actuarial balance. Now, before I introduce my panelists and open up the floor for questions, I wanted to share with you 2 slides in the appendix, and I'll come back to them. Every year we generate these statistics from our clients and post it on our website, not the actual numbers, but you have the numbers that show some of the results from a database, actuarial statistics, demographic, etc. I won't go through all these, so I want to go through 2 of them. One is our distribution of ASOP number 3 actuarial status. As you can see, taking away the red bar where communities were not in satisfactory actuarial balance, 83% of our clients were in satisfactory actuarial balance, which is a good sign for the industry, and 37% received our actuarial seal. This is very important kind of measure, and what I want to add is that we work, let me put it this way, of our clients, 85% are in states where they're not required to do an actuarial study. In other words, these clients have voluntarily decided to engage in active liability management and trying to quantify their liabilities and set fees and reserves accordingly, so that 85% do this on a voluntary basis. And I pretty much feel this is the best outcome. When CCRCs are forced to do actuarial studies, they become more of a commodity. The board of management doesn't pay as close attention to the numbers and doesn't necessarily operate in a mode to ensure those numbers. So I can tell you from 40 years of experience that voluntary actuarial studies is something that works well for CCRCs and also allows them to have marketable fees, as well as give residents a sense of security. So for those 83% that are in satisfactory actuarial balance, they should be commended, and it's something that's achievable. If you may note, there's a 12% for qualified satisfactory actuarial balance. That just means that we feel their reserve levels are not as high as they should be. And by surplus levels, not reserve levels. These projections are based on a large number of assumptions, so it's important to have a contingency fund in case adverse experience happens. So what this means is that these 12% are in satisfactory actuarial balance. They're at least 100% funded, but they don't have the surplus levels that we think necessary to get an unqualified opinion. Then the other item I want to share with you are our standards. These are the benchmarks that we suggest that CCRCs should strive for, and they are sort of self-explanatory. But again, as you look through the results, you'll see how these come into play. They're derived from actual experience. And now I'm going to I'm going to give a brief introduction to our 2 panelists for their comments, and then we'll open the floor to questions. Brad Breeding is the co-founder and president of My Life site, and part of my typo, it's about a site that provides information to consumers about CCRCs across the country. And Jack Cumming is a CCRC resident and advocate for financial solvency within this industry. So let me first ask Brad just to introduce himself. And actually, I don't know, Brad, if you want to even show your webcam, you don't have to. I see Jack has, but feel free to just give a few comments about yourself.
Well, I should thank Lynn for making this happen. I'm labeled here as Lynn somehow, but thank you, Lynn.
Well, I am not prepared to be on video today, so I'll just go with the audio. But thank you so much, AV. I thought that was a wonderful, for you to be able to take such a complex topic and to put it in terms that I think practically anybody could understand, especially me, which says a lot. Then you're doing a great service. So hopefully it's been a big help to everybody on the call today. Want to just thank you for your work. You know, we get questions all the time at our website, at My Life site, about what to ask, what to look for. We've even got guides on our website about this kind of thing. And so the actuarial piece, in my opinion, is becoming a bigger and bigger component in terms of, I think, people's awareness of that. And so you're helping to further that awareness today with this webinar that you're doing. And certainly we're going to do all we can at My Life site to make sure that, you know, that word is out there, that this is such an important component. But I do think also what you mentioned was important. I think there is sometimes people perhaps feel that an actuarial study is a foolproof measure. And as you said, it is a extremely important component, but certain market factors could change that. That would be out of your control, or certainly out of the reach of what a actuarial study could control. So I think that's important. And I don't know, I'm interested to hear some of the questions, so I'll kind of, I'll go ahead and let Jack speak. I'm sure that a lot of what I might bring up would be covered in some of the questions you'll get. So thank you again, and with that, I'll turn it over to Jack.
Okay, and AV disappeared here, so that's interesting. Can you all hear me?
Go ahead, I'm here. I'm just looking at questions, so I don't want to distract anyone. But yes, we can hear you, I think.
Okay. First, I want to note that I am an actuary, so this is something that's been of interest to me ever since I moved into a CCRC 12 years ago. And from listening to AV, it's evident that this is very complicated. There are many elements involved in running a senior housing enterprise, and particularly when you bring entrance fees into the picture, and that all that the actuarial report does is to provide an analytical tool which can help managements to better understand the kinds of risks that are embedded in the contracts that they're offering. So prudence becomes very critical in approaching anything as sensitive as the senior housing industry, where you're taking care of an aging population who can be vulnerable, etc. First, I just note two observations that occurred to me as I was listening to AV. One is rules of thumb are not scientific business tools. So what the actuaries are doing is creating this very complicated model, more complicated than the accounting tools typically are. And that by having that complicated model, they're better able to hone in on the specifics of a particular enterprise. And if there are recurring actuarial studies, they can refine the assumptions over time to reflect the practicalities of the particular community. And that can be a very big help to management in ensuring that the community remains financially sound. The other is that for an enterprise that takes money in advance to provide benefits later, it's not appropriate to just use cash flow. Now, AV mentioned Social Security, but we all know that there are intergenerational inequities inherent in the way Social Security has been handled. And that that becomes a problem when you're asking a smaller generation to pay for the retirement of a large generation like the baby boomers. So those are the thoughts that occurred to me as we looked at this thing. I particularly like the points that AV had on slide number 6, where he had 3 simple concepts. I don't know whether you can go back to that.
I have, Jack.
Yeah. So I just thought, you know, are your reserves adequate to meet the obligations? And are the fees adequate? I mean, that's really what you're saying. Is the whole enterprise financially sound for today and for the future? And that's important when you're in a trust business. Those are my thoughts.
Well, thank you, Jack. I'm gonna bring my webcam back on, and folks, pardon me if my eyes seem to go back and forth because I'm trying to go through some of the questions that have been asked. And the first one, first is slide 14, addressed to me, and I'm thinking, or actually it's addressed to Brad and Jack, when I mentioned that cash is king is not sufficient. And if you always speak to this, and if not, they said, I see that CCRC balance sheets with net asset value to negative six figures, and the value is becoming more negative each year. So sort of the disconnect between accounting and possible actuarial standards. They don't necessarily show what the actuarial position may be at that time. It may be underfunded, it may be slightly funded, but maybe Jack and both Brad could talk about should one look beyond just cash in looking at financial solvency for a CCRC?
Well, yes. I mean, if accounting has any meaning, then a negative net asset position is not a desirable condition to be in. I think it's as simple as that. So if you say, well, a negative balance sheet is of no concern, then that's, if an accountant says that, that would be saying accountancy doesn't have any meaning, because accountancy is only valuable if it's reflecting the underlying economics of the enterprise. So if the enterprise is sound, it will generally have a positive balance. Now that's difficult for if you're using entrance fees as a financing vehicle. But if you, there are ways of using those entrance fees for financing, but keeping track of the liabilities that the entrance fees were paid to fund. That's the insurance model. And the industry has avoided that, going toward that insurance model, with the effect that now there are concerns about these negative net asset communities.
Brad, do you want to add anything to that?
No, I think Jack is probably can shed as much light on that as anyone that I'm aware of, and so I think his comments are really spot on. I guess my question, and I'll turn this back to Jack, would be, Jack, if there are those on the call, sounds like the person whoever entered the question perhaps is in a community that has that situation currently. You know, what do you feel like? I guess my point is, without scaring people, you know, what kind of situation they're in. What is the sort of anecdote, and what might be the outlook for a community that is in that situation if we don't, and maybe we don't know if they're in satisfactory actuarial balance or not? What would you recommend, Jack, from there if somebody finds that to be the case in their community?
Well, it would certainly be concerning. There are, most of these communities do not go all the way to insolvency. Insolvency occurs. The investors here are the debt providers. So if you get to the point where you can't meet your debt covenants and you can't cover the debt, now you're in real trouble. That means you burned through all the cash that came from the entrance fees. So that certainly is concerning. But you know, there's no. I think the important thing for residents to understand that is, unlike the situation with banking, insurance, and brokerage firms, there are no guarantee fund programs for this industry. So if it does go toward receivership at the state level or bankruptcy at the federal level, generally the deficiencies are going to have to be made up by future fees or in some other way. In general, residents have not been asked to move out of their communities. And it may be that you got a bargain because you were underpaying for what you had up to the time of the insufficiency. But in the future, it will have to be made up, and all the money eventually has to come from the residents. So residents need to be heavily involved in these financial considerations, unless the industry were to step up and put in place those protective mechanisms as they exist for insurance, banking, and securities.
Let me just add one thing and try to put this in context, not to alert folks. I guess the one thing I would say is that if a community has negative net assets and there are no actuarial studies being done, that is the appropriate time to ask the board and management to do an actuarial study. And this is not a self-serving comment. in my presentation, I tried to stress, and one thing I should say, one value of the FSO is that when you do an FSO, you've done most of the work you need to do an actuarial study. The gap statements were designed for products where the revenues that came in during an accounting period were designed and offset by the expenses that came in during the accounting period. It was not designed for a product where there's a prepayment of revenues. So you're using a tool to measure solvency that can't do it. And for 30 years, we've been talking about, between the accounting and the actuarial professions, trying to design financial statements that converge for CCRCs. That hasn't happened. It came somewhat close in the latest round when they were revising ASC 606 and doing worldwide convergence on accounting statements. But it didn't happen then. They decided to continue, give folks the option to do what they've been doing, or a new option. So it's not going to happen in the future. The actuarial study will tell you whether or not this site is insolvent. And there are a lot of things in accounting that can create negative net assets and how they treat bond financing, et cetera, and early refunds that may not necessarily mean a financial insolvency. So the actuarial study will tell you that, generally speaking, there is a matching between an underfunded status and negative net assets, but that's not always the case. But an actuarial study will tell you where you stand with your current residents, which of your contracts you sell to new entrants are adequate or not, and then you can develop a plan if it is a material imbalance to correct it over time. But that is the appropriate time. So just because you have negative net assets doesn't mean that you are actuarially insolvent or not in satisfactory actuarial balance, but you need to use that tool to figure that out. And it's really more about, let's get the information out there. And again, even if you are underfunded right now, as long as management has a plan to be fully funded, is good. The danger is that if you never look at or quantify where you really are, then you may have a tendency to not adjust fees as you should, and therefore make things even worse. And the one other point I just want to make is that one of the things about the debt covenants and the bond finance industry, that again, they're using a tool that's not designed for CCRCs. And I'll divert by that. Though, when I was in college, I used to do an internship in the early 70s at an insurance company. And one of the first tasks I had to do was develop an asset share model, which was a model that basically says for a block of insurance policies, whether or not they would be profitable over their lifetime. Well, that's actually what we do with CCRC actuarial studies. And my point is that in terms of, if a community is insolvent right now, it can be improved over time. And the bond covenants of, you can have a bond covenant of 1.2 times debt service annually, but you can have 50% cash to debt. And if, because your turnover was low in 1 year, you don't meet the bond covenant, it rings red flags, whereas you got enough cash to pay your debt service for the next 10 years. Those types of rules have not been changed or adapted to fit the CCRC contractual model, and it's unlikely that they ever will be done. It's been that way for 40 years. So what's happening is that you're using a set of tools that are really not appropriate for a CCRC, and that's really the value of looking at your actuarial study to say, here's where we really are.
AV, could you say a word about this concern that about your concern about the continuing care model, that may move more toward a rental, or what is exactly your concern in that area?
All right. A good question, Jack. And I have one other question I want to bring as well. My concern in that is that, and it goes really to the bond financing and how it's done. Because there's concern, well, entry fee receipts are variable. We don't want to count on that too much for meeting our bond covenants because we're focused on cash and we're not going to accept any other measure for solvency. There's a pushback in a sense to say, let's get more and more products that are less entry fee based or have monthly fees go up to match costs, so therefore we minimize our risk as provider and bondholders. Well, my experience has been that the Type A CCRC contract is a well-working managed care long-term care insurance policy. And so if we allow the continued push for financing and focus on cash is king, as opposed to measuring solvency by doing the ASOP number 3 test, it's going to eventually come to a point where maybe no CCRC can effectively offer a Type A contract because they won't be able to meet their financing requirements. And that would be unfortunate that a beautiful product such as this that helps meet the financial security needs for many of our forthcoming baby boomers who studies show haven't saved as much as our parents, that we won't be able to buy this sort of long-term care policy and its benefits and preserve our income and assets, as well as not worry about running out of money. So it's possible. I mean, the trend is heading that way. Fortunately, and I've been in the industry for 40 years, for the day one when I joined this industry, there was always lament that Type A contracts were dinosaurs and they were going to be extinct in a few years. So far, there's still about 50% of the industry, I believe, in terms of total contracts sold. So it's still hanging in there. But again, if a lack of understanding of how this product works leads us to a belief that a Type B or a Type C contract is safer, that would be unfortunate and really doesn't fit with the facts. One other question I'd like to ask you is that someone mentioned that they have an actual study done triennially for state requirements by a national firm. They feel that some of the assumptions are optimistic compared to historical performance, occupancy, etc. Does an actuarial firm have any obligations to ensure assumptions are realistic based on either past performance or corrective actions identified by the provider to support non-historical assumptions? Or in the case of my location, can the actuary simply say the findings are based on the assumptions furnished? If the latter, then the study is essentially useless, they say, because it's not supported by historical assumptions. A good question. Part of the actuarial opinion, I didn't focus on that, should say, and it's in the standards, the actuary thinks the assumptions are reasonable. So when you're hired by a client and they provide assumptions, and the key issue is that how quickly they will fill up. There are other assumptions as well, but it's really the fill up assumptions, or if they're low oxygen, will they be increasing? Does the actuary continually accept that if their community is at 70% oxy and they say they're going to get to 90% in the next 5 years, and they do that year after year after year, does the actuary have an ethical or professional obligation to not use those assumptions? I would say there's probably a professional obligation after the first year where the community has missed their growth assumptions to refine those and maybe not grow them as quickly as they were expecting, so to speak. We have our own internal standards on that, and even if a client might insist on a second or third year to have increasing oxygen assumptions that are more rapid than what's been experienced, we will often include in the report a projection that shows what if occupancy stays constant, and that's embedded in the report. So the baseline assumption may be this increase, but the alternative is in the report, and the actuarial opinion should be written where it expresses that kind of concern, or there should be a caveat section, et cetera. So if again, it's all about context. These things should be laid out, and that's why when we're talking about actuarial reports, you really should see the whole report, because if you don't know all the assumptions involved, it's easy to be misled. Jack, did you want to add something to that?
Well, this is the same independence challenge that the accountants have, because they're paid by the clients and they want to please the client, and the clients don't always have the same level of integrity as the professional might bring to the thing. And so the question is, where does the obligation of the professional take them? If the client is asking you to do something that it's inappropriate to do you have to resign the account or whatever? In the insurance industry, that resulted in having a regulatory standard. So insurance companies, they can use GAAP for their investors, but they are required to meet a statutory accounting standard that is developed by regulators, and the regulators are deemed to be fully independent of the clients and to have the public interest at heart. So I think that's a question. If the industry is going to continue to have a very low level of regulation as it does now for these financial and contract matters, then it will have to meet a very high integrity standard and be able to demonstrate that it's meeting that standard. And I think that could become a challenge for this industry if it were to become a bigger part of housing for the elderly.
Good response, Jack. Next question. Is it totally optional of management to share actuarial reports with residents, or does management need your permission? I can't speak for all actuarial firms, but for our firm, we just ask management to inform us, and rarely do we deny sharing the entire actuarial report with them. Now, mind you, there are two kinds of reports we do. There's an annual report that's a summarized version, and in that case, we'd rather management give them a summary that we help them edit, but if it's the full report with 100 pages, sharing that whole report is generally fine with us. We just ask management to let us know. It's a tricky question, but generally speaking, it's management's discretion in that regard. But the key is just to convey an appropriate assessment of where the community is right now, with the caveats and understanding that this can change over time. There are lots of assumptions. There are issues there that are important, and also be aware not to create alarm for clients. For example, in my anecdote where I talked about a community started out there was 90% funded, no residents were asked to see the report back then, but the question is, when you're on a plan to improve and get to 100% funded, do you have to share the report at that time? It's a judgment call in each case, but we're generally supportive of sharing information appropriately with residents. And I have done literally hundreds of presentations on our actuarial studies to client resident groups where I was invited specifically by the board and management. So I think that it's not uncommon for them to do so. These are very complicated matters and require explanation. Another question is, our state association has struggled in Maryland to get legislation to require actuarial studies every 3 years for Type C communities. The providers oppose because of the cost, and it's only a snapshot. Is there a better strategy since you say voluntary is better? Well, we have clients who have said to me they've drunk the actuarial Kool-Aid. They're not in a regulated state. They do actuarial studies on an annual basis and use that information to set their pricing and fees. Jack and I have actually talked about this. My strategy, I think, is really, to educate residents of CCRCs on the value of actuarial studies and protecting their interests and making sure that their community is solvent, or help to make sure, to provide information to help the decision makers make decisions that will lead to the long-term solvency of the community, as well as with prospects, people interested in the community, say, if you don't have an actuarial study, why should I trust your judgment solo on whether or not your community is sound? And that's one of the reasons why we invited Brad as a panelist, because his site provides comparative information for CCRC prospects to look at. And again, whether or not they have actuarial studies might be a question that a prospective resident could ask, and also might be something that one could include in their profile, so to speak. And I'm seeing a new question here. How do communities that haven't done actuarial studies set pricing? And what is the importance of actuarial studies for Type C contracts? Let me do the Type C, and that's also the one in Maryland that they argue, well, this is fee for service. We got an upfront fee. We don't need an actuarial study. It's only healthcare. That is just simply not true. What gives rise to actuarial studies is the pre-funding of any cost. And that pre-funding is manifested in the fact that they are charging an upfront entry fee. Doesn't matter whether it's A, B, or C. That upfront entry fee is somewhat like an annuity in terms of how it should be used, but basically that's where the pre-funding comes in. And I've never seen a Type C contract charge an upfront entry plus monthly rental fees that covered all their costs. The marketplace just doesn't buy into a product with that big of a surplus. So my point is, if you're charging an upfront entry fee, and yes, we gotta get a definition of what constitutes an upfront entry fee, but let's say it's at least 12 times the monthly fee, then it gives rise to pre-funding, which gives rise to the benefit of using actuarial analysis to determine your solvency, because you now have revenues that are to be used over the lifetime of a resident. What about communities that haven't done actuarial studies set pricing? I think they look at what the market will bear. They look what their competitors are charging. I don't know if they always look at, are we offering similar products, but it's somewhat guesswork. I did my first actuarial study in 1979. Back then, I think that community was brand new. They felt that their board, the management team had done a good job. They hired a Wharton School professor to do an actuarial study because they wanted reassurance. And if memory serves me correctly, they may have been slightly underfunded, but not too far. There were minor adjustments. I think most of the time the fees are not draconian increases. And the fact that our median funded status is over 100% tells me that actuarial pricing is sound, so it's doable. It's just a question of, do you want to make your decisions with limited knowledge and hope that they're right, or is it in your fiduciary responsibility to use all of the knowledge at your fingertips to make this decision? Notwithstanding, actuarial studies are not free. So who can place a value on how much you're willing to pay for an actuarial analysis now? That really depends on the current board and management. I was not joking when I said the cost for our clients on average who do a study annually is less than 1/10 of 1% of their operating budget. That's still not, it's still cash dollars when you look at it, but the question is the value of getting this information sufficient to avoid mistakes or not? I think it's immaterial, but everyone has their own opinion on that regard, and I think I'm fortunate that the clients that we and other actuaries work with, which I think is about 30% of the industry, feel that it is worthwhile doing that.
Well, AV, I'd like to make one quick comment on that too before you move on to your question. For those on the call, I really think that in terms of budget for that type of an expense, if that really was an issue, I almost look to sales. I think that this is also, I think there's a bigger connection. If anybody read our post this morning, I think there's a bigger connection between this topic and sales than some, particularly management, stops to realize, because I think it's evident from the number of people on this call that this is what, prospective residents clearly want peace of mind about the financial soundness, and actuarial reports play a big role in that, and as you've discussed today. And so I think it should be as much of an expense that might be covered by some aspect of sales as much as any other part of the budget, because at the end of the day, I really think that this would help drive sales.
Good comment. Right, good comment. Another question we have here is that, let me read it. In the CCRC parlance, how important are annual population actuarial studies as we experience more aging in place on the impacts of level of care and assumptions for median SAB? I think that it is important. These actuarial studies are a snapshot in time, so if you can afford it, doing them annually is the best way. It should be part of your budgeting and pricing process each year. If not, doing them every 3 to 5 years is sufficient. But never doing a study and just assuming that you are sound and relying totally on gap statements or ratio analysis, I don't think it gives you sufficient information to make solvency decisions and to be able to say to residents, we have sufficient cash to meet your future needs based on a reasonable set of assumptions. Oh, here's a good question. Why won't my manager show me a resident the complete actuarial report? There are lots of, an actuarial report, as I said, is over 100 pages. There are lots of assumptions that are involved with it. There's some decisions about those assumptions that the board, management, and actuary think are reasonable. If you share that full report, and I know some clients that do and some that don't, then you also invite the residents to start challenging those assumptions. That's their right to do so, but at the end of the day, the board and management and actuary have to agree upon a set of assumptions they think are reasonable and reflective of the future. So sometimes it may be appropriate to say, rather than get bogged down in the debate over what the assumptions are, we've got a reasonable set and we're going to update every year, so that's sufficient. Another item is that when you're looking at the pricing of different contracts, not all contracts may have the same actuarial margin, and some contracts may be more favorable than others, either by accident or by design. That may or may not be something that the board or management want to get into discussion on right now. They may say, or even more in particular, when it comes by unit type. It turns out in virtually every facility, because most of the costs are wages and per person based, the pricing structure is favored toward the smaller units. In other words, they end up being at an actuarial deficit, whereas the large units end up being an actuarial margin. one could argue that, well, wait a minute, we do this on cost, the smaller units should be pricing more and the larger units less. But we know from a sales viewpoint, people value larger units more and are more willing to pay the fees. And if you started raising those smaller units to be their covered actuarial costs, you wouldn't sell any. So there's certain judgment calls on how you socialize costs that are involved in an actuarial study and analysis. So I'm speculating here that sometimes to avoid a sort of conversation that really there's no right answer to. I know sometimes folks ask us, well, what should be the right second person entry fee? Some communities charge none, some charge that person entry fee. When I first started out, I thought I had the answer, and over the years I learned there is no right answer to that. It's just a judgment call on what you think is appropriate. So long answer to your question is they may have reasons which they haven't expressed why they choose not to share the report, but the fact they're doing actuarial studies is a positive thing. Question, how do we get our CCRC board to do an actuarial study and share at least a summary of the study? Good question. I don't know if I have an answer for that one, other than say, because ultimately as prospects and residents learn more about the value of actuarial studies and it being a tool and also in conjunction with assumptions, it should become a standard for any well-meaning CCRC board to engage in this behavior. We're selling you a lifetime contract. We want to make sure to the best of our ability that we're pricing this correctly and accumulating reserves appropriately and not overcharging you. Actuarial studies don't mean that necessarily that you have to be charged more. It may be that fees can be less, so we have adequate surplus, so therefore we can raise fees at a lower level. I think just educating the board of management about this and asking them why not, and ask them questions. Well, how much cash should we have? How much reserves should we have? Can you quantify that for me? Really ask them to show how they quantify it, and then if they can't quantify that, possibly they might begin to say that this may make sense, and then they'll probably come back and say, well, it's costly. In that case, the residents should be able to say, we understand there's a cost to it, but it's part of our monthly fees, and we feel comfortable with the value of that cost in relation to what our monthly fees are. But it's a dialogue. Next question here. Any suggestions to motivate blank or other large providers provide periodic studies and make results available to resident representatives under appropriate confidentiality and judgment guidelines? Well, it really ties on to this other question. I don't know how to get them to do that. They should. I think this residents, as more and more residents and prospects become aware and ratified behind liability management is important, because you're selling me lifetime contracts, and we want to make sure those liabilities are measured and funded. They may get the message if they're resistant to it now. I know a lot of our clients are multi-sites and have gotten the message and share with their residents, either have us come out and speak or involved in the pricing center. So it's not unheard of for CCRCs to do this type of thing. There really should be nothing to be afraid of. I mean, again, as I've said, you don't have to be fully funded now. So about that liability management, that I want to know where we stand and that you're making plans to improve it or at least not go backwards. I had a client in Virginia, a different client in Virginia, who was fully funded, wanted to do a major expansion. The actuarial study showed as they did this expansion and they were filling up again, their actuarial status would become underfunded. And then, but in whatever number period we chose, they would be fully funded again. And the board adopted, said, this is our plan. So now when they got their actuarial study updates in the second year of the expansion, they could say to residents, yes, it was expected that we would not be fully funded now, but we're moving in the right direction. There's just a lot of positives in terms of communication with residents, in my experience, about actuarial studies. But again, that's just, I'm probably just an anomaly in that particular issue.
AV, I'll add one quick thing while you're looking at your next question there about that. You mentioned a phrase earlier in the call, fiduciary responsibility, and hopefully those who are serving on the boards of various communities understand that they do have that responsibility, but they may not fully understand what is involved in that responsibility. So I think if you can help the board connect the dots between their fiduciary responsibility and the value of actuarial reports, then that might help motivate them.
Good point, Brad. Exactly. And when I've talked with board members, I always had a positive experience that they want to do the right thing. This is a complicated kind of contract, and they want to help to figure out doing the right kind of thing with that, and that would resonate with them. You have something, Jack, you want to add?
Well, I was just going to say, if Catherine Pearson were on the call sheet, the word fiduciary always triggers something. The board has a fiduciary responsibility to the enterprise to ensure the solvency of the enterprise. So that's important. But in terms of a fiduciary responsibility to the residents, some states, particularly California, for example, where I'm familiar with it, they've enacted a statute that say that the providers have no fiduciary responsibility to the residents. That's something that residents might want to be aware of in thinking about this, because it is a trust undertaking. And I think that, again, is something that the industry would be wise to address in a constructive way.
Good point, Jack. Our next question is, it sounds like as a resident, we should be pushing our boards and management to do actuarial studies if we have negative net assets. What are your thoughts? I think you should push them to do actuarial studies regardless of your gap position, but certainly that is a motivating factor. That explain to me, if we got a negative net asset, which one would normally think sign of insolvency, why we should not be concerned as residents. And an actuarial study could come in and possibly show maybe that negative asset is a function of an accounting convention as opposed to a true insolvency. So yes, that's something as a tool to maybe get their attention in looking at that. Next question, is the dashboard only done for ASOP and not for actuarial compilation reports? We do it for both. Actually, it came out of the summary actuarial compilations, but we include them in our full comprehensive studies. And it's just a way of just showing, comparing the past 2 years for a client. And often when we do board presentations, we may show a chart for the past 10 or 10 years of the funded status for a client. But anyone who's doing regular studies, they can see where they stand. Next question, and we have about 10 more minutes. If the CCRC decides to expand by borrowing an amount that is 50% more than the current debt, would it mean the actual balance before the debt be changed or to unbalanced? Not necessarily. Actually, on an actual balance sheet, if you borrow money and say you borrowed $50 million, that's $50 million in cash. That did not change the actual surplus or deficit. Now, as you begin to do your expansion and as you're filling up and you have some startup losses as the facility's expansion is filling up, there may be a hit. But just the fact of borrowing money does not change your actuarial status. It's a little bit more complicated than that, but that is an overview. Borrowing money, that's cash on the liability side and the same cash on the asset side and the same debt on the liability side, so they're a wash in that regard. Let's see. All right. If a CCRC is legally attached to a large public nursing home, is actuarial study for both together called for or just the CCRC piece? It can be done either way. If when the resident transfers to the nursing home, if they're just charged a per diem rate, then that could be factored into the comprehensive actuarial study for the ILU assisted living component, and then the charges for the nursing are just on a per diem basis. Alternatively, one could encapsulate that nursing home in there and decide whether or not to include any gains or losses associated with the nursing home operations as part of the CCRC's of actuarial study. It can be done either way. It just depends on the particular situation that we're looking at, what you're trying to answer. Explain type A and contract and others. Very simply put, a type A contract characterization is sort of a legacy contract where residents pay essentially the same monthly fee as they transition through the various levels of care in their facility, be it independent living, be it independent with aging in place and getting some health care, home health support, be it transitioning to assisted living or nursing care unit or onto the dementia unit or vice versa. So in other words, the residents essentially pay the same fee further out there through entire lifetime in addition to the entry fee. A type B might be some bump up in fees as they go from independent living to, they may provide home care at no cost, but then when they go to assisted living or dementia, they may pay 80% of those costs. And nursing care may be 90% of those costs. There's an infinite variety of those type Bs, but basically it's a bump up from what they were paying before. And then type C is a so-called fee for service where actually they're supposed to pay the per diem rate, so they might get 15 days a year free, but not in many cases they may not be paying the full cost for assisted living, dementia, or nursing care. Those are B and C are sort of fine gradations, and they're not really precisely defined, but they're pretty much anything different from where a resident is paying essentially the same fee they paid in ILU when they transition over. And obviously there's some variations in type A where it may be they pay the average 1-bedroom fee when they get into assisted living nursing. But they're just general categorizations for the different kinds of monthly fee terms. Do you foresee the day when fees, entry and monthly, will be determined individually on an actuarial basis? In other words, someone entering at age 71 would pay a different fee for someone coming in at age 84. Well, actually, this happened about 20 years ago for a client of ours in California, where they had entry fee pricing based on the age of the resident, and also they went one stage further. They did their pricing instead of allocating costs on a square footage basis. They assigned all of their units an ambiance factor between 1 and 4. So, say a 2-bedroom unit with a nice view to such and such street may have an ambiance factor of 2.5, whereas an interior view 2-bedroom unit might be 2. So they went very progressive in how they allocated their costs and the pricing. And at the time, there was a thought that maybe this wouldn't be acceptable. They maintained full occupancy, and actually, it was something that was generated internally by the residents working with the board. But that's the only exception I know of nationally where it's been done. I'm not a marketing expert, but the theory is, I've heard, is that let's keep the pricing structure simple so we will socialize it across all ages. And this goes back to a question about what is the right first and second person fee for entry fees. These arguments are really endless. It's a question of, do you have a well-structured fee structure, fee concept, and you may weight it across different dimensions, and as long as the marketplace accepts that, that's fine. But it's a personal preference in terms of there is really no one right answer for that. Okay. Has your firm ever been hired by the residents to do an actuarial study if management is not willing to do one? No, we have not, but it's always the first time to do anything. All right. Do you take into account that a life care community may be an equalized pricing CCRC versus the more classic type A? If I understand your question, the actuarial formula applies whatever your contract terms are and the assumptions about operations and capital expenditures, regardless of the particular contract terms. So the actuarial methodology can be applied to all these contracts, and also can be applied for both nonprofit and for-profit entities, even with estimating what the tax liabilities may be, or even partner distribution. So this formula works. It's a mathematical formula. It works as long as we know what your contract provisions are and can get access to the appropriate fees. Okay. If the management uses up entry fee for current expenses in 10 years, but the resident's life expectancy is 50 years, is this unsound? Probably. I mean, we'd have to be a little bit more specific, but I mean, if you're saying they run out of cash, then yes. How one uses the money and how much cash is left, I mean, we'd have to really evaluate that, but let me put it this way. Entry fee-based CCRCs should generally be having increasing cash and investment balances over time. Because what you're doing is you're starting with, here's our liability. Let's say it's startup, it's $100 million, and monthly fees cover $70 million. If 10 years down the road, inflation has doubled those liabilities to $200 million, and monthly fees are $140 million, keeping the balance, then your reserves should be $60 million. So your reserves went from $30 million to $60 million, and reserves are your cash and investments net of debt, so that those balances should be increasing over time. Did you want to say something, Jack?
Yes. A common thing I hear is people say that Social Security is having a challenge because people are living longer and longer. And I want to comment on this question of longevity, because that was implicit in the question. Actuaries are very good at projecting improvements in mortality, and we do that. So if somebody lives to be 150, which would be unlikely, there would be some, the actuaries would make provision for that. Maybe 150 is too extreme, but we certainly now run our mortality tables out to age 120. And so I don't think people need to be concerned about that. We also forecast improvements in mortality due to the improvements in the healthcare industry. So that's all taken into account and need not be a concern.
But thank you, Jack. And I'm going to add one thing that as we close out the question, there's several I didn't get to. I'm assuming that the system will allow me to save these questions. I'll try to answer them in writing and send them to NACRA. In regard to this, what if people live longer than what you're expected? I've done some mathematical tests, and let's just say, for example, in today's assumptions, the state actual assumption, 20% of a resident's lifetime will be spent in a higher cost center, assisted living, memory care, nursing care. The fact that someone will longer, I don't think that folks are going to be likely to be living longer, and that percentage of being disabled is going to be increased. And our tests show that when people live longer, actually their pricing will be more solvent because they have a longer period of time to build up those reserves while they're independent. But the risk, what does increase is that the likelihood that someone will run out of money. So it becomes more important as we expect people to live longer to add this financial aid or benevolence liability to the actuarial analysis, which is often not included in the same actuarial study, but could be. I'm sorry I'm not able to get to all of the questions, but my voice is getting a little bit hoarse, and I see several of them still left. So I'm going to try to make sure they don't get lost here. But we're going to go ahead and stop the recording now and stop the session. Thanks everyone for participating, and look for to go to the NACRA website to get more information. Have a great day. Thank you.